Very good morning, everyone. I once again welcome all the participants on this Sunday morning for the Valuation Manthan session 34. Valuation Manthan session 34 on valuation of real industries, industries. This Valuation Manthan, which is a great initiative of Valuation Standard Boards of ICAI, it's under the leadership of its chairman, CA Hansraj ji, and vice chairman, CA Priti Savla. This is for the benefit of all the existing as well as aspiring registered valuers. Due to some commitments, our chairman and vice chairman is not available today. So I start this session with a brief introduction of our honorable speaker, CA Lata Gujar More. Lataji is a leader of the valuation practice for BDO India LLP with over 25 years in valuation and corporate finance advisory services. She has specialized knowledge in areas of valuation of business, intangibles, IFRS, etc. She has carried out valuation for arbitration, disputes, mergers and acquisitions, regulatory-based valuations involving regulators such as SEBI, RBI, High Court, Income Tax, etc. She joined BDO in 2017 and was instrumental in developing the valuation practice, including setting up practice for all three classes of assets, that is land and building, plant and machinery, and financial assets. Under the leadership of Lataji, BDO Valuation Advisory LLP has been awarded Prominent Registered Valuer Entity in November 22-23. She has represented before domestic and international arbitration panel as an expert witness for various corporate and supported counsel for cross-examination for counter-party valuations. She had undertaken 1,000 plus valuations in her career. She has a hands-on experience in implementation of merger, demerger. She has worked on financial engineering, restructuring of 6 companies and mergers and acquisition transactions, deal advisory. So with this brief introduction, I request Lata ma'am to start the session.
Thanks, Anisa.
Thank you, ma'am.
So, good morning, everyone. I will share my screen to start the presentation.
Good morning, sir.
Good morning, good morning. Good morning to one and all.
Yeah.
Good morning, sir.
Good morning. Have we started the session, na?
Yes, sir, we are just about to begin, but I will request you to address give a welcome address to a participant before madam starts.
Okay. No issue. So, I welcome each and every participants from nook and corner of the country and beyond the country also. You see, like in the economic sector, if we talk about the real estate is the one of the biggest sector where we find the economic growth, the contribution for the employment, and the many bigger things which really by which the India is taking shape of to become a developed nation. And the valuation front, if we talk about, this is really complicated and the certain issues, whether it is the under the regulatory system or the non-regulatory system on the commercial and the business system of the country. Many things on a day-to-day basis, things keep on changing. In the dynamic environment, the demand and supply and many things happens with. Fortunately, this valuation standard board of ICI start moving into different, not limiting to the financial assets, but the assets which are related with the land and building or otherwise plant and machinery, and many newer things which has been drawn attention by the government also to the ICI, and the ICI in itself has bringing strength to the system. And today we have with us our Lata Gujar More. She will be speaking us and touching us the valuation of the real estate segments. I welcome you, Lata ji, and Anisa Kaji. She will be the moderator to take this session forward. Just a second. We've been joined by our co-chairperson also. Our co-chairperson of the board, CA Preeti Savla. She hails from the Mumbai and she contributes a lot into the system of the development of this valuation standard board. I, on her behalf and on my own behalf, and on behalf of the whole board, welcome each one of you. I am really thankful to the office team and everyone around us as a speaker or the moderator, and each and every participants to bringing this valuation standard board to a different level, to the next level. The journey of bringing so many newer things, this valuation manthan, though started at the initial days of this year, but continuing in the 34th series today. I'm very grateful and thankful to each one of you. With these words, I go back to the moderator of the program.
Thank you, sir. Thank you so much. Madam, we can start the session now. So over to you.
Okay, thanks, and good morning, everyone. So today's topic is real estate, and I think Hansraj ji has touched upon the sector. The sector is huge, in terms of employment providing. It is the second largest after the agriculture sector, and it is third largest in terms of getting the FDI into these sectors. And sector is kind of, if you see, I will just quickly put up the what is expected in this sector is it is expected to grow to 1 trillion by 2030, and it is expected to contribute 19.5% of the CAGR, and 13% to the GDP by 2025. Of course, long-term 2047 projections are too far for us, but yes, it is expected to touch 5.8 trillion. So this is the sector. So there are huge opportunities for valuation since the sector is growing also. Yeah, of course, there are three kind of segments generally come for the valuations, which are residential, commercial, and retail space. So residential market is booming, right? Which we are in Mumbai also see. There are number in terms of number of units, also in terms of the value also. The residential space is growing very fast, and in terms of commercial also. I will not read the kind of the numbers which are there, which are kind of visible here. It is. And again, the retail multi-brand sector, retail is anticipated to stimulate the demand in this sector. So basically, kindly you can divide the major contribution of the sector in this space is residential, commercial, and retail. Now let us go to how to undertake the valuation of the real estate. So I will put up the valuation of the real estate. I will go back to the international valuation standard. They have put the valuation into two segments, So the first segment, which IVS 410 talks about, is development properties. So what is the development properties basically development property, to be very simply to understand the project which we see around, either which are under development or near completion, which could be residential, commercial, and as I said, the retail space projects. So these are the comes under development properties. So first is like project under development, which I said. This would also include the plotted land, because if we must have seen, if you go far from the Mumbai, in the around Pune and other area, the plotted area land is also coming up for a sale. So the plotted area land is also covered up in the development properties. Then you see a lot of SRA projects around the Mumbai. So SRA projects, which are kind of redevelopment projects, also come under the development property. Then refurbishing of the existing building, sometimes you must have seen that the floor increase or they're refurbishing any improvement. So that things also come into the development property. Another thing is the land allocated for development of the statutory plan, or maybe the land sometimes is used permissible for relevant activities as per the development plans, which could be the hospital, the school or colleges. So this kind of projects also comes under the development property. Another use is sometimes the land, you get a higher FSI for the land or higher density in the statutory plans. So that also falls under the development property valuations. So these are the broad categories which fall under the development property. Then the next standard is defined is the real property interest. So what is the real property interest? The real property interest is basically you have a right of ownership, control, or to use this land and building. I think we must have seen that sometimes, the property is on the kind of lease, either perpetuity or, or maybe for 100-year lease. We have seen around this. So this kind of interest falls under this. In this interest, there are three kind of interest which has been defined. One is the superior interest. Superior means interest means the owner of this interest has absolute right of the possession and control of the land on any building for a perpetuity. And this could be the freehold property, but subject to reservation under the development plan. So sometimes if you see in the development plan, because of that planned city, your land goes for some amusement park or garden around it. So you may have that this thing own this property, but these there is a reservation for development on that property. So this is called a superior interest. Then coming to the subordinate interest means here you can say around, if you see the industrial land, which is, basically the state government of the each, you give it for 100 year or 99 years, or sometimes, it's for perpetuity land. So this kind of falls under the subordinate interest. The third is you have the right to use. So the third right is the right to use means suppose there is a ready building or land is there, you have right to use, but only for specific purpose. Sometimes you must have seen in the private parties also, they give the land, to the another party, but there is a specific use, like either you construct a hotel only, or you can use it only for a hospital, but no other activities is kind of permitted. So this right is come under the right of specific use. Now let us see what is the valuation process. So as regard the valuation process for any business is generally the same, but difference here is that here a lot of kind of preliminary or due diligence is expected to be done before kind of starting the actual valuation work. So what is due diligence? We will discuss in the next slide, but generally you need to take a primary due diligence or initial review of the project. So now the evaluation of the various documents and data, which will go on the next slide. Then comes to the selection of premises of the value. The premises of value is again the same, highest and best use, going concern value, or you need to do is as and varies basis, or it is a orderly liquidation. Because if you see in lot of IPC cases, you must have seen that there are lot of properties which are coming up for a valuation, or companies are owning that property. So we need to basically define first what is the premises of the value under which we have to value it. And next comes to the valuation date. After selecting the premises of the value, you have to kind of understand what is the date for which you have to undertake the valuation. And all the market parameters which we'll discuss now, we have to select it around that valuation date. Then comes to the selection of methodology. So as regard the valuation, whether it is land and building, plant and machinery, approaches are same, but the way you undertake, the process or the methodology is little different. So there are three general approaches which for any valuation is there. For real estate also, there are three approaches, that is market approach, cost approach, income approach. And the fourth approach which has come up, and you will find that approach even in the exposure draft which international valuation standard has come up. They have also included the residual method in this. So residual method, we used to use it earlier, but now it is come as a formally into the standard. Then after this, you need to do the market research. Market research means gathering and analyzing the information of the comparable project within the vicinity. Because you may see that the area change, the valuation, the property rates are changing. And again, it depends upon, what kind of facilities are available, what is the kind of premium project, or normal kind of building is there. So basically comparison and of this correct project is very kind of, essential when you are undertaking the valuation for the real estate. Then undertaking the valuations, after doing all this, you need to select the methodology. You need to check the reasonableness of the assumptions which has been provided by the management, and then you have to do the valuation conclusion. So this is the process of the valuation for the real estate. We'll now go to the what is the kind of primary due diligence which I had talked about. You need to do it lot of primary due diligence. First is the understand what is the purpose of the valuation. So purpose of the valuation is very important. It is for any valuation, but yeah, of course real estate it's more important because you can see in the market now, there is a lot of institutions are buying the portfolios. So it could be for acquisition of the loan portfolio, it could be for the borrowing for loan purpose you are doing it, or it could be from the tax perspective, because nowadays you will see that even the stamp duty authorities are asking for a valuation now. So it could be for stamp duty or income tax purpose. It could be for litigation and dispute purpose. So there are, we need to understand the purpose very well. And then after understanding the purpose, you need to go, what you need to do first after accepting the engagement is that the property which you have to value, or the project which you have to value, understand the legal ownership and interest of the property. Like as we have discussed, there are three interests. So what exactly interest is there? Sometimes there is a joint development where the land is owned by one person and the developer is developing it. Then this kind of projects, if you are there, then you need to understand what are the kind of financial terms agreed with it, because that is the value driver. And if you are doing it for a kind of developer, the valuation will be different because he will have to take the profit sharing into account. And if it is for the owner of the land, his share, based on that you will value that property. So this is very important thing to understand what is the interest in the property, who has appointed you for the valuation, his particular interest. Then after that, you need to undertake the site visit. I would say that site visit is very important because that gives you, hands-on kind of, or that gives you the feeling what is the property is, because when you get information, and more specifically, under develop projects under development. So what status they are, whether plinth is completed, what floor is completed, or only land leveling is going on. So even for kind of doing the development properties, I would suggest a visit is very important. Another point of visit comes in from the, because as I said, this kind of either it is under development project or it is a land or plotted. So your plotted land also comes under the development property. So you need to visit and see that what is the condition of the land, whether the vegetation is there, it is coming under the forest area, what are the environmental compliances you need to be done. So when you visit this, you need to understand, basically you get a feel of it, what exactly you are valuing, the project or the land. Then coming to the, in case of land, you need to see the ownership document. Nowadays, if you see in the Maharashtra, all the land records are available online, so quickly you can do it, that checks, online check. Or if you feel that online some issues are there, you can appoint, there are lawyers who undertake, the title search and all. I'm not saying title search is kind of your part of role. You can rely on the management, but sometimes, you feel that if the online records are not available, then we can go for a title search by a lawyer. In case of development project, you need to see what is the layout or what is the sanction plan of it or approved plan of it. And I just wanted to add here, in case of big, housing projects, the approval comes in the stages. So what stage that project is, you need to see that, and up to what stage that approval has come, we need to understand it properly. So that comes to the, approval. Then you have to see that there is a NOC from the various authorities which we need to kind of take as well. One is the construction permit, then intimation of disapproval, any disapproval the project has received, environmental clearance certificate. We must have seen around a lot of projects that kind of hampered because it comes under the forest or there are environmental issues there. So these are the 2 3 kind of pollution control, Ministry of Environment and Forest, and coastal regulatory zone. Because you must have seen that in Mumbai there are a lot of land which comes under the coastal, and there are different regulations are there. So you need to check all these things. I'm not saying you need to check in the sense you have to ask your client to provide all these things. So you need to verify it basically. Then coming to, in case of agriculture land, there is a before going into the kind of any project, the land need to be converted into non-agriculture. So what is the non-agriculture conversion status of the land? That also we need to verify it. Another thing is, the basically the competition of the FSI or TDR, which in the example I have tried to touch upon it little bit to give you the understanding of it. But this is basically generally what we do. The land client give us, but we compute ourselves also and see that whether it is kind of nearest or closer to it. And if it is higher or something, we ask for the approval kind of from the client. What is the regulatory approval they have opted. So, and I think in the example I would be able to explain more, but yeah, this is the FSI and TDR is the most critical part of the project. Joint development, I think I already spoke about it, where if it is a joint development, go to the agreement, understand what is the parties, agreement in the financial terms in case of revenue sharing, in terms of cost and all. Comes to the SRA and low housing kind of projects, if you are doing it, you need to see the statutory approval. Basically, some projects are approved by the Pradhan Mantri Awas Yojana. So you need to see that, the approval related to that project. And in case of redevelopment projects, you need to specifically see the minutes of the society, who has approved and whether this is approved as a majority by the requisite majority by the members. So this is very critical in case of redevelopment of the project. Then we see nowadays, I think in terms of transparency index also, India has kind of come to the 36. Actually, we have improved 3 notch from our earlier rating. So there is a lot of information you get on the RERA website also, which is available in the public domain, and you can check this project related information whether the project is RERA registered or not. So you can check on the RERA website, and you can also check whether the company has any approval. Nowadays they give the green building IGBC approval. So check that that approval has been received or not, or is in the process. Then in case of projects which are kind of under development, you need to see what is the RERA compliances developer has done or not. You need to do the quarterly compliances of the RERA. So you need to see that whether the RERA compliances has been done. So this is the kind of preliminary due diligence you can undertake before going into the valuation. Now coming to the valuation approaches, as I said, the approaches are 3, which are any valuation, but residual method, which has come as a 4th thing into it. So what is the cost approach? The cost approach is here says that the buyer will not pay more than the cost of the assets. So what is the cost of the assets you derive in this cost approach basis? After kind of, adjusting for the risk or any inconvenience and other factors which are involved, you arrive the cost of the project. The methodology could be your replacement cost or reproduction cost. So replacement cost means you have to replace these assets today, considering his physical conditions, the life and everything, what is value. And reproduction means if we have to construct this building, what is the reproduction cost of reproduction cost of it. So that comes under the cost approach. Income approach, again, what is the basically cash flow expected from development of this project, that you take into account. Under this there are 2 methodologies. One is discounted cash flow method, or another is the rent capitalization method. Rent capitalization method also comes under income approach, because that gives you again the future cash flow taken into it. Then coming to the market approach. So market approach, in case of real estate, also forms a part of income approach also, because market approach says that you comparing the assets with the identical or comparable assets, which you need to undertake when you are doing a discounted cash flow method also, by comparing the projects, basically the selling price of that project. The residual approach, which is a combination of basically the market approach, income approach, and the cost approach. So again, methodology, as I said, there are two types of asset as per the international valuation standard. So which kind of methodology use for this? So development property, which I had explained, you can use the cost approach also. But the cost approach is used where the property there is no active market on the completion. So there you can use the cost approach. Income approach, as I said, DCF and rent capitalization method. Market approach means comparing the similar asset properties, which could form up the part of DCF also. Then fourth is the residual method. So basically, residual method, what it generally use when you are valuing a specific assets with larger property, and it helps to allocate individual component in the property. So basically, I would say that the land which are coming under now the urbanization, but which is not developed, and there is a huge plot of it which is not developed, and you have to value this plot. So apart from the other methodology, residual method generally can be used to understand what is the value of that property. Then comes to the real property interest. Real property interest, again, the cost approach, income approach, and the market approach we can use, because here you have a right to use that property, as I explained. Now let us see the valuation of under construction project. So this under construction project, how can we use the DCF, and what are the parameters of it? So basically, what are the cost estimation is very, very important thing. One is the construction cost. Then there are approval cost. Approval cost would include everything, the statutory approval. Then you have an architect, structural engineer. All that comes under that approval cost. Then the RERA registration cost. Soft cost means the marketing, and basically road shows for the projects and all. Cost escalation also form a very important role, because you can see that the cement prices or the labor which is used for in the construction, the prices are going up. So what kind of escalation need to be used? It's the very important decision in this kind of project. And again, it is a demand supply as regard the labor is concerned. So you should be very cautious when you are taking the escalation into account. Construction phasing, how the phasing is happening, because the big project, if it is a one building, it's fine, it can be completed within 24 months or something. But if there is 100-acre projects which you are valuing, then the phasing is very important. And financing, of course, is very important. What kind of debt equity mix is there? In terms of revenue estimation, you have to kind of estimate the selling price. I would say we don't generally, the developer provide it, but we have to kind of do our own due diligence to see that, it is falling under the reasonableness. So selling price, the price appreciation, and the sales volatility. These are the three parameters which are important when you are doing the revenue estimation. After doing the cost and revenue estimation, you arrive the net cash flow, then your tax rate, then you're deciding the WACC and adjusting the WACC for risk factor, because each project will have a different risk. So let us see how this DCF work into it, So I have taken one example. See, project ABC is a residential plus commercial mixed development project spread across 12.3 acres of land area. The project has total 7 towers, and it is developed under 4 phases, which I was explaining, So there is a phase 1, G1, phase A3, A4. These are the phases we have kind of defined. So if you see the total land area, if you convert this 12.3 into square meters, this gives you 49,895. Now you will see why my net plot area is different. So this is a 12-acre plot. So you have to keep some space for your infrastructure, your road, kind of in between it. So therefore, the plot which is available for a development is 41,850. Now coming to the permissible FSI, we generally, I said, need to be checked, which we have checked. But if you see the actual FSI they got is around 18 lakhs 92,423, which has been kind of actual FSI and on the base of which the project will be developed. But this how this 1432 kind of be arrived or used generally, which we check. Uh, the permissible FSI over total land, which is for 30-meter and above road widen, is around 3. So basic FSI is kind of 1.1. You get additional FSI on payment of the premium, which is 1.5, and maximum permissible TDR loading is 1.5. So all these things, you need to go to this UDCPR regulation is called. It's Unified Development Control and Promotion Regulations for Maharashtra State, which has published in 2020. It would be advisable to go through that and understand it, just to check that what we are valuing, it falls within that regulations, more specifically the area. So this is the way we have kind of calculated the basic BUA, the additional BU. So basically, if you see the area multiplied by this, specific 3.1.1.5, you will get this different kind of permissible BU you have. And here it is existing where, because this project, as I said, was under development. So existing 57 lakhs is already 57,000 is already kind of developed. So balance is new to be developed. Then you get this ancillary kind of FSI. So total permissible FSI which we have around is around 14,32,859, and project has got a approval of 1892. So if you are taking this 1892, we have kind of checked the proper permissions, what the developer has kind of obtained, and then you can take it. This 18,92,000. So in this case, which we have kind of verified this, and therefore we have used 18,92,000. So basically, you will see we have kind of arrived the built up area, and the approval is got on the super built up area. So between the built up and super built up, the loading is around 33% is permitted. So which we have kind of within the range. So this help us to kind of form an opinion. The area which has been considered for the project is around fine. And though the developers are selling, and it is a RERA guidelines to sell the project based on the carpet, but your financials number work on the super build up, because your construction cost, everything you have to spend on the super build up area. And these are the area statement, which, kind of what is the residential development in this office and shops. This was in the first phase, and this is a second phase, third phase, fourth phase, you can say. So this is the kind of total area. Now coming to this, you have to kind of see the sellable area, which had already explained how we kind of generally verify and see that it falls within this, within the limit of the regulation. Then coming to the sellable area, you see this is the 588, this is the phase-wise things. 26% of the first phase was completed, and the construction cost was kind of considered is 4,000 for the project. Now, how you will check the 4,000 cost is appropriate or not? So there are generally will find many property consultant report which gives the approximate cost benchmarking. We can check that. Another thing which we can have a kind of talk to construction contractor and get the area kind of cost feel of it, or estimating by the valuer itself. But here you need a help of the land and building valuer when you are doing it yourself. So there are 2-3 ways generally, you can check the cost, so that you see that what developer has taken it's kind of reasonable. So then coming to the, as I said, the escalation. So annual escalation, how you will kind of opine on this, the annual explanation. So generally you see that cement and steel goes more into it. So you see that what is the escalation or appreciation prices are expected in those two sectors, and based on that you can form an opinion on this. Then this is a construction cost to be incurred is 181, which we have calculated. You will see you will not get 588 multiplied by 4,000 this number, because there is an annual escalation which you have considered in the cost, and that therefore you'll have to put it in the Excel sheet and work out based on this annual escalation what is the construction cost. But it is not directly, because 588 lakhs you are not going to kind of develop it in the first year itself. So if you see here, the next table, cost phasing for the project is very important. So what it says that this is the phasing, right? How is it goes from the first phase goes in the 4 years. So first year 6% you will complete, next year 38, third year 48, and then 8%. And similarly is the phasing is done for all the three kind of phases. So, how you will work out the cost? You first put this 5 lakh 80 into the 88 into the phasing, then you put this apply this cost with the escalation, and then you arrive at the phase wise cost. Now coming to the revenue assumptions, which I was saying, because DCF also kind of forms part of the market approach. That is why, because this is your area, which is unsold area, which will match with the total phases. Now, what is the selling price? You will see here residential, office and shops, each three has a different rates. So how you will verify these rates, So the verification of these rates will be done by comparing the similar project within the another project within the vicinity. But when you are doing that, you need to put characteristics of the property into very well understand, because the location, the location also matter when it comes to office or shops, and even in for the residential, because if you the view, it depends on the view, your premium also changes. So the location factor is one important. The quality of the construction or the facilities which are provided into the building, and then the age of the building, because sometimes you get the instances with the next building which is a kind of little 10 years old or something. So when you are taking such kind of instances, we need to adjust it properly. And the permitted use is also very important. So when you are taking a samples around the area, you need to adjust it. And how we are adjusting, I will explain that in the next example, which you will understand generally how you. Of course, there is a lot of subjectivity involved in this, but you should have your proper working, and how you have kind of assigned what you feel that the basis should be there. So that helps you to kind of defend yourself for the rate or the selling price reasonableness which you have assumed. And as I said, the whole project cash flows are developed based on the super build-up, because your construction cost goes on the super build-up. You have to construct everything. So when you are taking this selling price with the market, you need to see that what is it, because in the market you will get the carpet area. Your project is on super build-up basis, so you need to adjust that selling price also when we are doing the comparison. And escalation also, here also escalation comes, because you must have seen around the prices are keep on kind of changing. But the escalation again, it's an area specific factor. We sometimes, if you are not getting it, then we can go with the general property index or something. But it is advisable to take into account the area specific escalation, because again it depends upon demand and supply in that area, the quality of the projects which are there. So the escalation, I think we need to form the opinion after verifying all these things. Now, sales, as I said, cost, there was a phasing. Similarly, sales also, there are two important things. The sales velocity. It means, you may construct it, but you may not sell everything at, once you complete it. You generally, if you must have seen, the developers start selling immediately after the kind of plinth or before the plinth also sometimes. So sales velocity is very important to assume. So you see the yearly how much you will sell in each phase, that assumption plays a critical role here. So this is the sales velocity. And then after selling the project, like 8% you say if you sell in FY23, how the payment will come? Because 100% project, you don't get kind of upfront, you don't pay. So the phasing of the collection is also very important. So you will see here first you get 60%, then 75. You get under development properties, you get based on the completion stages, the payment. So these are the two factors which plays a critical role in terms of when you are deriving the revenue. Now, coming to the cash flow, I think all of us are aware it's a TCF methodology. So I may not spend some time on it, but yeah, this is the basically after doing all this assumption verification and forming opinion on the reasonableness of this kind of revenue and cost which has been provided, we kind of arrive the net cash flow based on that. And here, if the borrowing has been done, you need to take into account the borrowings, the loan payment and interest, and again the working capital expenditure, because working capital initial stage of the project you need it. Once you start kind of complete it, then you in the real estate kind of the working capital requirement goes down. But again, it depends upon the type of the project. If it is a bigger projects, then definitely your working capital block also will there. So you need to kind of check or that assumption very carefully. Then on the net cash flow, you apply. See here, the accounting profitability in the because accounting is a different thing in the kind of develop specifically this kind of real estate industry. So we generally take a tax on the cash flow basis only. So whatever the inflow of the which you have kind of derived based on the past assumptions you have explained, you take into account the net cash flow after that, and on that net cash flow, the profit you take a tax into account. Then while kind of deciding the discounting factor, the risk plays a very huge role. What kind of risk you need to adjust it here. And in case of phase wise project, you may have a different risk for the each phase, because it depends upon the the risk which has been covered, the finance risk, the completion risk, and all that. So I think this is the back which everyone were familiar with it. I will just talk more on the risk factor. So while deciding the risk factor, what you need to take into account the construction stage, whether it is at plant stage, it is at under construction, or whether superstructure is completed. What are the approval status? If the approval of the project is also not all approvals, more specifically the environmental forest clearance are not there, that means there is a approval risk also is there in the project. So we need to kind of decide that. Then the duration of the project, if the project is already delayed, then you need to see that. And duration of the project comes from your developer reputation also in the past, how he has delivered this project. That also helps you to kind of see that the whatever project duration it was planned, it will complete or not. So mm, and therefore the next is the profile of the developer, whether he is at very initial stage and there is no track record for it, but his track record, you can see that basically the projects in the past, if he's as an employee, he has an experience of doing this, so that also matter into it. So developer profile is also very important. Past project I had already touched upon. And natural calamities, COVID or earthquake and all, what are that risk factor is, because generally you that comes more specifically, it gives hint from the how the construction quality is, that goes from the cost, or when you are looking into the construction, and you will come to know the quality of the construction. And generally nowadays projects are saying that they are taking care of kind of this kind of things. So we'll have to see all this kind of as a risk factor and adjust our discounting factor based on this. So I think basically, you can put a matrix for the each project, and based on that gives a rating and kind of arrive, because the risk factor is always a subjective things, but how you are creating your record and forming the opinion, why the risk factor you are adding, whatever X, Y, Z, that we need to kind of have a solid basis for it. So based on that, as you can see, your total inflow, which is the revenue assumptions which we have discussed. This is my total inflow. This is the total outflow on account of cost, and cost not only the construction cost, the other cost, admin cost and all also. This gives me the net cash flow, the tax which you have arrived, and this is your the discounting factor. We generally take the midpoint because you cannot generate the cash flow at the end or at the beginning. It goes slowly every month. So you take a mid factor into account, and then you arrive at the present value of the cash flow. And I would say that, generally in the developer case, sometimes you go on the quarterly basis also, because here the project moves on the quarter to quarter basis. So it is better to take quarter, but if it is very complicated and big project, then you can go on the yearly basis also. Now the next methodology will come is the residual method. Uh, Residual method also I will kind of take you through the example for a better understanding. But what is it? As I said, residual methodology used when you are doing a kind of land which has come into the urbanized zone, or where there is a big plot is there, but there is no plan what will be done and all. In that case, generally residual methodology is used. And residual methodology used as a second approach. It's not a kind of primary approach. Generally, we kind of try to see that, because a lot of is assumption based. Here you see that check the area to be developed is as per the local development control regulation, which I said in Maharashtra you refer this kind of UDCPR regulation to check that. Then you need to access the market rate, based for the sellable area, and then you need to compute the revenue. So in the projects which were under development, we were going on the phasing and calculating the each area, square feet and all that. In this case, you work on the very broad basis. Then again, the construction cost, which we had already discussed, you need to see the construction cost, consultant cost, soft cost and all. All you need to estimate it, and then arrive the net value of the assets, and then you estimate the basically discount it that value based on the life of the projects which you have considered. So let us see how it's work. So in this example, you will see the total area of the land parcel is 442.5 acres. This is the total area. 52% is industrial zone, urbanized zone is 39%, and green zone is 9%. This is the kind of bifurcation. The purpose of using residence, the land is situated in urbanized zone. However, as on valuation date, there is no clear plan for development of this land into any type of project. Hence, the residual approach is adopted. Now, you will see what is the area assumptions. As we see, total area is 442.5 acres. An area approximately 50.3 acre is under reservation for the DP road widening, etc. And 47.6 acre is under reservation for public amenities under the DP plan. So basically, when you are doing this kind of valuation, one is the regulation, and you need to see the development plan of that particular area and check. And based on that, you kind of arrive this area which is kept for the reservation and all. So if you see industrial zone, residential zone, and green zone, these are the three things, 442. And then your proposed DP road is 50.3 and area under reservation is 47.3. So net area which is available for you is 344.6, which you can encash or capitalize or develop. So therefore, you will see here industrial zone and residential zone, we have put it in two different areas. Total area industry is 231, which we have discussed 59%, and industrial is 171. Deduction 49, how it has been deducted. So what is done? 50.3 and 47.6 we have added, and equally it will deducted from the residential and industrial zone. So your net area is 182.2 182.3 in industrial zone, and residential it is 122.6. Now there is a green zone also, which we must have seen here. It's around 39.7. So green zone also we have divided equally. Okay, so your net plot area is this 2.202.2 for industrial and residential 142. And as I said, you have this, basic FSI on available on payment of premium, ancillary FSI. So this again you check from the regulations, you get this 2.6 and 2.5 and 2.6. This multiplied by this total area gives you this 18 lakh 59 and 12 lakh 70,328. This is the built up area which you can develop. Now, TDR entitlement, because you have kind of given up this area for the green zone, forest and all, so you get a TDR of it, which is generally, I think, twice the area. So you added that into it. And green zone FSI, which the area is gone again, 1.1. So you get 1.1 for the green zone and 2 for this reservation for amusement park and all that. So so this basic plus this 2 area for these amusement and all, 1.1 for green zone. So you will see the total which you can develop is the row number 14, which is 23 lakh 43,940 in case of industrial zone, and in case of residential 17 lakh 54,862. So therefore, proposed area utilizes 2.9 to be utilized. So you get total built up area is around 252. In terms of square feet, this is 2 crore 52 lakh 30,178 and 1 crore 88,89,352. And this is the way you arrive the total built up area. So development period is generally, we have assumed that a development period for such a huge area, because this is comes under recently urbanized zones. By that time, you will get the approval, then you will start selling. So totally, we have assumed that it will be 30 years you will take. And 30 years mean you take a midpoint, which is a 15th year for your all discounting factor and all. Revenue assumption, sales price is considered 6,000 based on the the market analysis or market projects which are there in the market. Based on that, it has formed the opinion. And 6,750 square feet for the industrial area. So this is a square feet. Escalation is 2% for 15 year, and total revenue is around is 3. This is in million, so it is around 38,678 crores. How it has been? So this rate adopted, which I had explained you, the area you can see it has come from the area statement. Escalation per is 2%, and this 6.72 is the base year revenue. You escalate for 15 years, and then you arrive the revenue of around this for industrial and as well as the residential purpose. So now coming to the construction cost, because we have discussed how the revenue has been arrived. So similarly, we have to kind of decide the construction cost. So construction cost has been considered is 1,650 for residential, and industrial is 1,500. See, industrial is generally lower than the residential because it is not industry. There are big kind of floors are there. So compared to residential, it is lower. And again, I said there are 3 ways to kind of basically form your opinion on the construction cost. One is your own analysis. One is that you can see what for the existing project which is going on, and one is from the expert who are into this sector, take their opinion on it. So, and infrastructure development, because it is a huge plot, so there will be infrastructure development for access road and all, which we have assumed around 140 per square feet. Escalation again 2%, wheat factor is 15 years. So total construction cost is 95 lakhs 710. It is around 9,571 crore in short. So you will see this is the rate adopted. This is the area which we had come from the area statement. This is the escalation, and this is the total cost. And land development cost is for both. It's for industrial as well as this residential at the rate of 140 per square feet. So we are getting this number, which is around, these figures are in million, but I'm reading in crores. It is 9,571 crore. Now, after doing all the assumptions for revenue and cost, we will work out how the residual value will work. So, this sales which we had already discussed, we have taken from there. This is your construction cost. Then, as I was saying, there is a architect cost, architect fee, matlab sanction plus structure designing, everything. So, generally, here we go with the thumb rule. We have taken 10% of the construction cost. That is a broad estimate based on the past experience and this thing we have formed the opinion. It is 10% of the cost is for this, and 2% of the revenue is for the administration and other advertisement and all. So this lays the cost of FSI, which we have assumed that we'll pay the FSI, 0.4%, 0.4 as a FSI will buy for it. So my total cost is this 11,527 crore. Then developer profits. So developer profit, we generally you assume in the range of 15 to 20%. We have assumed here 15%, considering it's a long-term project and celebrity and all. We have assumed 15%. So that gives you the net revenue. From that net revenue, you remove the tax, which is at prevailing rate. That gives you the net cash flow what this project will generate. Then we have taken a discounting rate of 13.85%, and 15 years is your mid period. Based on that, your estimated value comes to 2,282 crores. So this is the way residual method is kind of used. See, there are a lot of assumptions goes into this method. So therefore, it is generally not preferred to use this as a primary approach, but this is generally used to corroborate, what you have arrived, or where the information is not at all available, then you kind of use this in rare cases as a primary method. The next method, which comes under the rent capitalization method. Under the rent capitalization method, let us see how it works. What are the factors which are important? So, rent capitalization method, you can use it for the existing rented property also, or where it is proposed to be rented, that property also. And generally, it is used for commercial office space or retail space kind of, valuation. So analyzing the data inputs, it's what you see. You see the built-up area, carpet area, or leasable area. So basically, you have to form the opinion. What is the area which you will available for a rent? Then what is the monthly rent of it? You have to assume for a security deposit, because generally in rented you get security deposit. Then general outgoings on account of maintenance of the properties, and other things. Then escalation clause. Generally rents, you see 5% is generally accepted, or you take 15% in a 3 years. That is the escalation which is there. Uh, then estimating income and outgoes. So comparative analysis, again I said, is very important when you are using again the rent capitalization method. Property tax and all, generally if the property completed, you get it ready, or if it is undergoing and proposed to be constructed, you need to kind of estimate of it. So this is the way then you arrive the net operating income, and net income you capitalize, that gives you the value. So let us see the example of it. So example, we have said that the built-up area is around 1,30,023 square feet. This you verify with the ownership document of the property, if the property is completed, or if it is proposed. Again, I said you check with the developer if he has developed the commercial kind of building. So you check the documents and take an opinion on it. What is the area which is available for a rent? Rent per square feet is assumed 220. So this is the rentals. See, sometimes what happens, it is though there is a rent agreement, but it is always advisable to check within the vicinity of the kind of, that area, what are the rentals going on, considering the nature of the property. So it is advisable to verify these rentals because, and again, it depends upon the purpose for what you are doing it. If it is dispute or litigation, then you need to have a create a solid kind of data for it to base it the opinion which you have taken. It's 220 square feet in this case. So rent per month gives you, this is area multiplied by this, it gives you rent month, and rent year is multiplied by the 12, will give you 343.3 million. Security deposit is again, if it is actual, you can take it, or generally go with the market standard. What is the security deposit? You can take it. Uh, the security deposit also, you will keep it, in the something, you will not keep it idle. So we kind of assume 6.5% as a, income which you will earn on this. 5% is again the outgoings, which outgoings in the sense on account of the taxes and etc. You get annual interest on deposit is this, okay, 11.2. So your total income from this property is, net income is 351.9. The capitalization factor is 8.5%. Generally, the property, you get 8 to 9% in that range. We had gone with the midpoint 8.5% as a cap factor. So you are getting a value of around 414 crore of this property. So this is the way rent capitalization method works. Now coming to the fourth is valuation of commercial and residential properties. Uh, Here, commercial and residential property means, suppose the ready flat, sometimes you have to value, or someone want to buy the commercial property, they come to you and they say that, okay, you price this, what is the right price for it? So in this case, the market approach, which I was saying, which also forms a part of DCF, you have to take it. So you have to gather kind of sales comparable assets data. Then you have to analyze is the differences between that assets which we have compiled the information with our assets. You need to adjust it based on the location, size, marketability, utility, etc., and arrive at the fair market rate for the asset. So here, let us take the example how the market approach works. The location. The property ABC is a residential apartment located at Mumbai. So you can see we have kind of generally go to the Google and marked also where it is, to kind of see that, how far it is from the airport, railway station, bus stop, etc. Basically, the access factor matter when you are kind of pricing it or valuing this property. The construction was completed in 2003, means it is a 20 years old building. So as per sales date, when you are valuing this, again, you have to check the sales date. It's very important. You ask for copy for it. Who is the owner of this property? And that also gives you the, what is the built-up area and the carpet area. You take it from the agreement itself. So in this case, the built-up area is 600 and carpet area is 500. So this is a kind of example which I have tried to explain how generally, kind of the factors which was explaining, differentiate factor, what kind of matrix, how you put it. This is a by way of example. I'm just trying to explain. So here, if you see, we have subject property, which is ABC, and we have collected, say, 3 instances from around the area. So you put the name of the building, what is the location. Here I put the Mumbai, but in your working papers, you should have a proper location, the building. If you got a kind of specific instances, then you put the flat number also. What is the type of since I am valuing the residential, so I will collect the samples for residential only. How is the marketability? Marketability is good. It again depends upon your, the location. Negotiated rates per square feet. So we have got that these flats in these buildings were kind of negotiate 40,000, 42, and 41,000. So you see the rates are different. Then you need to check what is the physical information, in the sense what is the age of the building. So we found the age of the building is around, say, our property, target property also 20 years, and these were also 20 years. The floors, on which floors they are. Car parking, because generally car parking nowadays goes with these things. We have checked the car parking area. What is the carpet area of this uh, instances which we are evaluating is profile of the building. Ours is good, but this was very good. Again, this comes, therefore physical inspection is very important. You may not visit this flat, go and see it, but at least the visual, from the outside also give you this kind of feeling. And again, it is a kind of your assessment, why good, very good, and all. If required in your working, we need to have a why we believe this, that parameters also, if it is there, that helps you to create a kind of good working paper. What are the amenities in the building? We are saying very good, but in our working paper, you will see that we generally go and check that what are the amenities available, uh, in this building, and we note down that. And based on that, this kind of ratings, you can say, is given. Internal condition of the properties, furnished, unfurnished. These information generally we try to gather from the society or society secretary, or maybe, whatever way you possible, you try to kind of get it. Building frontage, whether it is available, not available, primary access types, what is it, visibility, visibility wise is how the buildings are and all. So these are the parameter, and on the right hand side you will see this is our assessment, and this is our kind of adjustment which we have done based on the analysis of these parameters of the sales comparable. So you will see the type of the property is, we are not adjusting because we feel that the type of the property is, the instances were also residential, but therefore there is no kind of adjustment need to be done. The marketability also no adjustment because they were good, both of them. The age of building is also kind of similar, so therefore no adjustment is required. Size also more or less 500, 600, so no adjustment is required. But the profile of the building, the profile of this A building, based on again our physical verification is the parameter which we have put noted in that. On the basis of that we give this, which we have given for A2, A1 and A3 -5 we have done. Amenities, this is the amenities based on again the assessment. Internal condition of the property, location parameters, the frontage, access and visibility is 0 because it was more or less thing. So overall in this you will get the -13% for A1, A2 -10, and A3. Again, it is based on our assessment. Uh, the rate which finally we got after comparing all these three properties, 36,000. And based on this, we have valued our target property, which is ABC, is around 1.8 crore. So as I said, because of course, there is a lot of subjectivity involved, but why we have kind of taken this opinion, which is based on the records which we are keeping, the evidences which we are collecting. So everything should be kind of documented. So this helps you to kind of justify the why you have kind of opine on this, the reasonableness of the assumptions which you have considered. The next thing is valuation of specialized building. Specialized building is, it could be warehouse or industrial building, and sometimes it comes as a part of PPA more, rather than doing the specific valuation for particular warehouse or this thing. But yeah, still it comes to value. So I will just touch upon it because it is more of a kind of land and building valuer job. We as a chartered accountant, we can understand the process, but of course we'll need a help of here, the land and building valuer, when you are doing specifically the cost approach. So this is again the physical verification. I would say that in real estate, physical verification is the primary things. As I said at the beginning also, physical verification. Then you do the due diligence based on the approved layout, plan from the concerned authorities. So you need to ask that to the client. Uh, Noting down the specification and type of construction carried out. See, we will understand, but if we will not go into that much technical understanding may not be there, which generally the land and building valuer can assess this. Then estimating the replacement value, with basically estimate the current construction cost assuming the specification. So then you can adjust this for the depreciation on account of loss of the completed life. What is it there? Then other factor that is depends upon the age, total useful life, physical deterioration is how the property has been maintained, the functional, technological, and economical obsolescence. That also you need to adjust it, and then arrive the estimated fair value of the assets. I will just take one small example into this. So replacement cost is a cost relevant determine the price that basically, if you have to replace this kind of property, what is the replacement cost today that you arrived at? And then basically, calculation of the cost is the first step, which we just explained. So calculate all the costs that would be incurred for this, for reproducing this property, or if you have to construct this new property, what is the cost will come into picture. You need to kind of assess that. Generally, as I again said, there are three ways, and in this kind of things, the structure engineer or land and building valuer, they go and estimating everything, what will be the cement, steel, and all, and based on that, this is kind of estimated, because each construction is different. Some construction have a higher steel element, some has a lower, so that they come to know, after doing the physical verification. And depreciation calculation and other obsolescences you do, and then you arrive the asset value. So here in this case, if you see, we have taken an example of the warehouse, warehouse building, which is at ground floor and structure. PEB structure, year of capitalization is 2000. Height is also very important in case of warehouse, because your construction cost is depend on that, which is 11.5. Total build-up area is around 3 square meter, not square feet. Replacement cost, which we have worked out, is around 63 million. So total useful life is 30 years. So and therefore the life is 30 years, the 2000 constructed building, so your balance life, useful life left is around 7 years. Your salvage value, because at the end, the building, since the steel and everything is used, you get a salvage value also, which is considered as 0.5%. The depreciation and other factor here, it comes from your physical verification, the life of the building. We have taken 74% of the value is kind of depreciated on account of that, and therefore depreciated replacement value is 16.6. So this is your replacement value 63 minus this factor gives you depreciated replacement value 16.6. Obsolescence or discount is 0 because the building was in good condition, and therefore the fair value of the property is arrived 16.6. I think that's all from the methodology perspective. Yeah, I would take now any questions if any is there. Thank you.
Yeah, madam, we can go for the question answers section.
Vasika.
I'll request all the participants to fill the feedback form as link is shown on their webcast screen. So you can also view this session and past sessions also on ICI YouTube channels, ICA Tube, but no CPRs will be granted for it. So for CPRs, you have to go for live sessions only. And this session will be updated after 4 to 5 days. Madam, first question is what will be effect on project hold because of the financial crisis, litigations, and any other reasons beyond the control of promoters like COVID, like position global recession?
So that would comes in your life of the completion. So all these factors. So project in normal projects, if it takes 2 years, but due to because of litigation, it will take time unless the litigation goes through or any kind of court sanctions gives you for construction of the property. So it will comes on the period of the construction. And again, discounting factor, which I said in the risk analysis.
Okay. So the judgment, this is my question, like the judgment which we do like for this giving the risk premium and the risk factors consideration, it can differ from person to person. Because if I may consider it as 5%, it may be like 4% for somebody else.
Yeah, it is a judgment call, but as I said in my discussion also, you need to have a proper backing of it. Why
Right.
you are
The
forming that
justification
opinion.
should be present.
Ideally, we should put a
Okay.
matrix into place, put all the parameters
Okay.
applicable. Generally how the risk assessment of any asset is done.
Right. Okay. Okay. What does retail segment cover?
Oh, retail segments means you must have seen the malls. You are asking the segment, right? To the multi brands, if you go to the any brand, sorry, malls which are there, so these are the retail segments where
Okay.
you get a various brand shops and all.
The next question is, do we give more value for building having IGBC certification?
So when you are doing a comparison, as I said in my all examples, you need to see the comparison of the similar properties. So if the comparable properties are also, you try to see that are IGB compliant. And your market assessment, you will feel that there is a little premium is there for IGB compliant building.
Okay. What is the concept of FSI and how to check permissible?
As I said in regard of this regulation, UDCPR regulation gives everything. That therefore I said you need to check that regulation when you are using the FSI, and I gave the example also how it is works. So some FSI use your primary FSI, then some FSI you can pay and buy, obtain it.
Okay.
So the regulation state everything.
So everything, like if we refer the regulation, we get an idea like what exactly has to be done and how it has
Yeah,
to be
yeah,
done.
correct.
How WAC should be decided and beta is the industry specific beta available?
The real estate industry specific beta is definitely available. There are a lot of real estate companies which are listed. But ultimately, because it depends. These companies, they have many projects, but if you are valuing only single project, then you need to kind of adjust it accordingly, in the risk factor.
Okay. While valuing the developer company, why is the valuer required to get into legal approval related aspects of the projects? I feel management representation should suffice.
So I would say that there are instances around you can see the cases, and as a valuer, you don't have to go and check that value approval is obtained or not, but better to take a copies for your record, not only on the management representation, because there are instances around the management representation is not enough. Our role doesn't end over there. We need to do a due diligence of it, which we are valuing.
Can any of this method be a choice for management or valuer?
No, it's valuer choice. It's an independent value.
Always all values,
Yes.
right?
And as I said, the residual method is secondary. So generally your approaches and market approach forms a part up to certain extent to DCF.
Right. Can you please explain working capital assumptions in DCF methodology? So there is no assumption as such in this.
Assumption again, it's a project specific, the value which you are doing it, the why working capital is required when you are launching a project depends on your construction cost. You have to see what is the kind of debt equity ratio of it, what is the cost you are estimating for it, and generally working capital you need for all these approvals and all, if it is at land stage. So working capital is again the stage of the project, and but once you understand the industry, then you can work the working capital very well, right? And there are broad thing, as I said, 10% of your cost generally for the architect cost and all, and 2% is a marketing cost. That generally is the working capital you need apart from the land cost and construction cost.
Right. The next question is how to calculate FSI percentage, and is FSI a mathematical method or based on regulations? I think this
I
we have
think this
already
is answered. I
already
would prefer,
discussed.
if you are
Yes.
doing real estate valuation, please go through these UDCPR regulations. That will give you quite a bit, knowledge and working purpose.
Whether a valuer has to adopt all three approaches and mark the least valuation, or one approach is sufficient.
So as a valuer, I would prefer to take it more than one approach because it's an estimate which you are trying to do it, right? So therefore it is always better to take one more than one approach, and maximum using methodology is better because that you give you the range, where it is fall.
But madam, if we are not having the details, we can give a disclaimer, right? Like we don't have, so that is why we are just adopting a single method. Is it allowed?
Yeah. See, it's on the how you are kind of defending how strong your assumptions are, right? But right, if you are not able to use any method, definitely it will end up using residual method, which has
Right.
lot of assumptions. You can use that, but giving a justification why you are not able to use the other methodologies.
What questions can be raised on our assumption?
I would say that, which I have seen around the questions which are coming after when you talk to the institutions or regulators is that, the title is not clear, the land area is different, the plot area is something else, but valuation may it is taken higher. So therefore, I was kind of harping on the preliminary due diligence and not on the management representation things. So these are instances which are there in the systems where the plot area is there, the location sometimes it is not there, but the valuer has validated. But these kind of things are there in the industry currently. So therefore, we should be conscious when we are doing it. And therefore, I said physical visit is, I think I would prefer to do it, whether it is a single building or small building.
So these were the questions, madam, which we have received right till now.
Okay, thank you.
Yeah, okay. So can we end the session now, ma'am? So
Yeah, from my
closing.
side.
Okay. It was a wonderful session giving thorough insight of the valuation of real estate. It was very excellent delivery and supported by a very good presentation. Madam, you have covered in detail the valuation process and explained preliminary due diligence, the valuation methods and approaches like cost approach, income approach, market approach, residual approach with regards to development property, real property interest. Then you have also explained in detail valuation process with examples under different methods for different various types of properties like under construction property, commercial and residential, specialized building. So it was really very useful and knowledgeable. And I'm definitely sure that all our participants must have benefited from this. And even the queries raised by our participants were, instantly addressed by you. So with this, I present a hearty vote of thanks on behalf of team of Valuation Standards Boards of ICAI and all the participants. Thank you, madam. And with this, we come to end of today's session. Thank you and have a great day.
Thank you.
Thank you,
Bye.
ma'am. Yeah.